Let's talk to Ronnie Chopra. He is the Chief Market Strategist for Knightsbridge Trading Academy. Very good morning to you,
Good morning.
Ronnie. Okay, before we kick off, we're going to talk about three stocks today. You've said that you have no financial position or any shareholdings in these stocks, so that's not blurred. Okay, first thing, you're a contrarian investor. Simply, what does that mean?
It's basically someone that goes for unloved stocks or something that's against the market. And the ones that I've chosen highlight value in them at the moment, which I think is not realised by the market currently, but in due course should be.
But is it easy going against the crowd? Is it easy going against consensus?
Generally not, but the larger rewards are if you do go against the crowd.
Right. And in terms of your track record in picking stocks that are undervalued, have you had lots of winners?
Well, I mean, like you know about Sainsbury's being taken over, taking over Asda and the share price spurting quite considerably. That there are a number of stocks that have done fairly well, I think.
Right. Okay, well, we've got three to run through. Let's kick off with the first one. Dixons Carphone in every high street in the country. In a very simple charting, that doesn't look a great chart.
No.
Are they very deeply unloved?
They do seem to be very deeply unloved. I mean, going back a couple of years ago, these were trading around the £5 mark.
Right.
And at the moment, they're trading just under 170 pence. So yes, they are deeply unloved. But I think the fool is way overdone, because on fundamentals, these are trading on a price-earnings ratio of approximately 7. Compare that to its US peer, Best Buy, which is trading on a price-earnings ratio of 18, kind of highlights the undervalued nature of this company, whereby this is basically being valued at less than half of what its American peer is valued at. And I think that's extremely, unloved. These have had a profits warning in the last 6 months, and that's why we see that fairly sharp spike downwards. But again, these are the number one UK retailer in electronic goods.
Yep.
They've kind of transformed the layout of the shops. They offer a dividend yield of approximately 8%, which is extremely high in this low interest rate environment. And in fact, they're going ex-dividend tomorrow. So if anyone was to buy them today, they would get 7.75 pence per share final dividend, which equates to approximately 5% on just that half annual dividend, which is astronomically high, I think. Just why they're unloved is there is obviously a lot of competition from the likes of Amazon. Profits have fallen, and that's why the shares have come off. But they've got a decent market share, obviously, in the UK, in Europe, and on current valuations, they are extremely unloved. As I said, they're on a price-earnings ratio of around 7 or 8, which, compared with the general market, is less than half the market. So a lot of negative news is factored in.
Okay, so that's one to consider in your portfolios. Let's move on to the next one, ITV. Now, there's been big rumours about ITV for as long as I can remember, since I was in shorts. Again, the share price hasn't done a great deal, has it?
Well, they've done fairly well in the last 5-6 months, haven't they? When they were trading below the 150 mark, they're back around 165 at the moment. So they've picked up around 10-12%. From levels of 6 months ago. But last set of results very good. There are many major beneficiaries of the World Cup football, when England did better than expected. So advertising revenue has been very strong. As you've said, they've been a perennial bid target for a number of years. Liberty Media have been touted as a possible predator. Likewise, we've got other private equity companies possibly interested, the likes of even Netflix doing the rounds as well. And again, these are unloved at the moment because these were trading above £3 a few years ago. The bid rumours aren't going away. The weak pound obviously makes them even more attractive to a US predator, with the pound trading at a multi-year low at the moment. Again, on fundamentals, these are trading on a price-earnings ratio of 10 or 11, which again is below the market average. And I see value in them with or without a bid. So,
but in terms of the actual price action, obviously there's this massive change in the media world of the Netflix, the online. Okay, is ITV an old story?
It's one of the major UK terrestrial channels, And they still have a decent set of programs which get a lot of viewers, the likes of Britain's Got Talent and the other ventures that have, I forget his name now.
Big Bad, Simon
Simon
Cowell.
Cowell, that's right, thank you. So yes, advertising revenue is strong. The results recently were much better than expected. And I think there is certainly a lot of value in these at the moment.
Okay, so again, one to consider for your portfolio. Let's wrap up with the third one. The Royal Bank of Scotland still owned majority stake by the government.
That's right.
It's in the
Although
60s, isn't it?
I think so,
from memory.
yeah. I mean, they've been reducing their stake from, what was it, 87 or 83?
I think they
something
were
like
at
that.
87. And they announced that they're talking about reintroducing a dividend.
That's right, because they haven't paid a dividend for a number of years. I mean, these have been a complete disaster in terms of share price performance over the last few years. But I think a lot of bad news has been factored in. They've recently settled with the Department of Justice in the US.
So this was the mis-selling in the US, right?
That's right. And the shares did have a decent rally after that was announced, but they've kind of fallen out of favour again. But yes, as you say, with the dividends increasing over the next few years, they're profitable now, which is a nice change. These were at one time one of the biggest banks in the world. They own NatWest in the UK,
Yep.
Coutts, the private bank. They also still have a stake in Citizens, which is a fairly large US bank. But they've reduced a lot of their assets over the years just to streamline their core business. But yes, they are an extremely unloved bank at the moment. So again, with the contrarian hat on that I'm wearing, these do offer value. In old money, these are currently trading around 24 pence because there was a 10-for-1 consolidation.
Okay.
So these are down like 80-90% from their peak, which is a tremendous fall. But yes, I think a lot of negative news is in the share price. And with increased interest rates, the banks will get more profitable. And Royal Bank of Scotland should be a major beneficiary of this. So the net interest margin, the difference between borrowing and lending, once that increases, then these make more profit and they have a massive turnover. So even a small increase in the net interest margin would improve the bottom line considerably.
On that note, Ronnie, we've run out of time. Thank you very much indeed.